Hello, namaste, and good evening, everyone. A very warm welcome to today's webinar on Equity Market Insights by UTI Mutual Fund. I'm Sonal Mittal, Product Specialist at UTI. And if there's one way to describe markets over the last couple of months, it would be this. Markets have already lived through a lot in a very short span of time. From sharp swings in crude oil prices, geopolitical tensions in the West Asia, to pressures on the rupee and continued FII volatility, investors have had no shortage of reasons to worry. Yet, despite all the uncertainty, markets have repeatedly attempted to stabilize as investors reassess the longer term picture. In fact, in periods like these, separating noise from long term trends becomes even more important. To help us understand the current market landscape, we have with us Mr. Vetri Subramanya, our MD and CEO, who will share his perspectives on the global and domestic market outlook and how investors should think about markets in the current environment. We also have with us our senior equity fund manager, Mr. V. Srivatsa, who will later walk us through the investment philosophy and strategy of UTI Large and Mid Cap Fund. To introduce Srivatsa, he brings over 2 decades of rich experience in equity markets and portfolio management. He is known to follow a disciplined, research driven, and value oriented investment approach with a strong focus on identifying high quality businesses that are available at attractive valuations. Having joined UTI in 2002, he has managed research, offshore mandates, and domestic equity strategies. And he is currently managing UTI Large and Mid Cap Fund along with equity allocations across key hybrid strategies. Delighted to have you, Srivatsa and Vetri. With that, let me now invite Vetri to the conversation. Welcome, Vetri.
Good evening, everybody. Thank you, Sonal, for that introduction. And of course, we are now doing our, I think, third monthly market insight, during which the ongoing conflict in Russia, not Russia, but in Iran and Israel and the US is still a ongoing factor. Technically, there is a ceasefire, but in practical terms, the global supply chain, particularly the oil and oil product related supply chain, remains jammed. And so that becomes an interesting backdrop for a lot of things that we might be talking about today. But without any further ado, let's get rolling. I think Sonal has put together a deck covering a lot of global as well as interesting issues. So I'll hand it over to her to get the ball rolling.
Sure, Vetri. To set the context, let me begin with the first question. US has been in the receiving end of the oil shocks in the past. However, it is not reflecting much this time in US economy. What explains this shift?
Sure. So I think that's an interesting question, Sonal, and you can see, I think, what is the reality over here, which is the impact of energy on the US economy. And on the left-hand side, the chart that you can see shows the US energy consumption as a percentage of GDP over time. And what you can see over there is that over time, this trend line is continuously falling. So when you had the oil shock in the 70s, as a percentage of GDP, it was almost 12 to 14% of GDP. But today, it is down to almost just about 4% of GDP. And therefore, as a result, the impact of what happens to oil prices, remember, this is energy intensity. Oil will be a subcomponent of this, but essentially as a result of this, the impact of elevated crude prices on the US is very, very limited. Now, the impact on high crude oil prices may be limited, but if, for example, the US was a importer of energy and particularly of oil, then it would still have a dependency on the rest of the world. But that is where the chart on the right becomes very, very interesting, because what this is showing you is that from 2007, when their trailing net exports of energy was minus $150 billion, they are actually now sitting at a surplus, which is above the zero mark, which means they are actually net exporters of energy. Now, this I think is again another sign of why the US economy this time around is not experiencing the shocks that it experienced earlier, Sonal, simply because energy intensity has come down. And secondly, the US, which was the world's biggest importer of oil at one point of time, is now actually the world's biggest exporter of oil. Now, the high oil prices may have a negative impact on consumers, but certain businesses, the gas and oil producing businesses in the US, are the beneficiaries. So, at an economy wide level, these two benefits actually maybe cancel out, or in fact, it is net benefit for producers. And therefore, the US economy is actually not getting impacted this time by the increase in oil prices because of lower intensity. And secondly, they are now exporters, so they're actually net beneficiaries at a economy level.
That's interesting to know, Vetri. Building on that, US economy and markets seem unfazed by recent shocks. Are there any risks we should be mindful of?
Sure. I think that's interesting. And, the US economy, I think, in terms of growth, is continuing to look very, very robust. Most of the high frequency data continues to indicate a healthy trend. In fact, the jobs report that came out last week was again a surprise in terms of the strength of that, because people were worried that, given the elevated energy prices and all the other challenges, there could be some negative impact on the jobs number, but it in fact came out very strong. And in fact, the expectations of rate cuts in the US have now been pushed out further. But your question, Sonal, was about risk. So let's look at risk. One is, it's important to remember that over time, the share of GDP, which is corporate profits, actually tends to be mean reverting in nature, which means there are cycles in which profit as a GDP, as a percentage of GDP rise, and there are periods during which profits as a period of GDP fall. You can see that in that slide over here. The black line is the line which is a very, very volatile line, percentage of GDP corporate profits. And you can see from a base number somewhere in 1992, there is a gradual upward trend in this line. And in fact, it has now broken to an all-time high. Corporate profits are 14% of GDP. Now, because of what I would call the political economy, economic cycles and political cycles tend to, coincide, but sometimes they also collide. And therefore, this to my mind is certainly a risk when you look at the US, which is that corporate profits as a percentage of GDP are just very, very high. Of course, some of this is again driven by the Max 7, but this certainly would be a risk, because what we know from history is that profits as a percentage of GDP tend to be cyclical, and certainly they have certain mean reverting characteristics built into them. High profitability causes new companies to enter and reduce the profit pool. Low profitability causes companies to exit and causes the profitability as percentage of GDP to increase. The other interesting thing to see over here is the chart on the right, which shows you the EPS growth and how far away it is from trend. Trend is nothing but this constant line which shows you the consistent increase in US profits. And what you can see is that over time, the real economy has cycles, and therefore it moves up and around the long-term average. But in this last 4-year period, starting from the pandemic, there has been a significant shift. Many of us thought that there could be some setback to profits and it might show its cyclical tendency at this point of time. But courtesy the AI boom, it's actually taken off vertically, and therefore EPS growth relative to long-term historical growth trends is now significantly above trend. Now, because corporate profit margins are at a high, the PE does not look as elevated as it used to earlier, because the profitability number is so much more higher. But there is other ways to look at valuations, and I'll come to that later. But this simply is one risk. If you believe that corporate profits are mean reverting, if you believe that the political economy is always bargaining around the level of corporate corporate profits which are fair, then you would have to worry that corporate profits are just too elevated given its typical cyclical pattern. On the next chart, if we move ahead, we have another version of this. And the reason to look at this is that keep in mind that after the recovery that profits that happened during the pandemic, the big jump that we are seeing in profits is actually coming from the hyperscalers. These are the AI driven companies who are significantly investing in capex. Now their capex is a source of growth for the economy, it's a source of profits for the economy. But as companies do more and more capex, they are actually starting to dip into the cash flow that they are generating. So if you look at it in the past, these hyperscalers, which is the companies like Microsoft, Nvidia, Alphabet, Meta, all these companies put together, historically the four major US hyperscalers, capex as a percentage of their operating cash flow was significantly lower. They used to spend just about 40 to 50% of their operating cash flow on capex. That number has now climbed, and now they are spending almost 90% of their operating cash flow on capex, which means they are hardly generating free cash flow anymore. Now, therefore, this is driving profits, but remember, even though all these companies are doing capex, on the other side, if you see how AI is being used, you can see that the AI market is still evolving. Why do we say it is evolving? If you look at the right hand side, you can see that there's been a big movement in market shares in particularly the last few months. Something like ChatGPT, which had a 77% market share going back 1 year, has seen a significant decline to 56%. And then something like Gemini has come in at 26%. And of course, Claude, much smaller because it is currently focused only on the enterprise segment of AI, but is making vast inroads. They are actually one of the fastest growing companies, and their path to profitability also looks much faster. So why do I call this a risk? I call this a risk because now the companies no longer have free cash flow. All their operating cash flow is going into capex. Now, when you make capex, it's good for the economy, but eventually, if the capex does not generate returns, it will end up being a noose around the large amount. It will cause the return on capitals to start to fall. And when we see a situation where market shares are still evolving, it means many people are doing capex, but we do not at this point of time know who will be the winner. Is it Perplexity? Is it ChatGPT? Is it Grok? Is it Claude? Is it Gemini? These are still unknown questions. So not only are they doing heavy capex, we don't know who the winners might be. They may not be able to monetize this capex, and therefore this to my mind is another risk that we are dealing with at this point of time. Moving on from that, we have another interesting slide. Now, I mentioned this earlier that US PE multiples per se do not look very elevated, right? I mean, you can see over here, this is where the current PE multiple is. It is not very expensive. There have been many times where the PE ratio has been much, much higher. So from that point of view, you could argue that, look, the US market is not very expensive. But this chart shows you a very different behavior, because what we are plotting here is the MSCI US 12-month forward PE premium. And on the x-axis, we have the US 10-year bond yield. What we see is this relationship over time, that initially when bond yields go up, the PE multiple also tends to move up. But beyond a particular time, particularly once the bond yield, the 10-year bond yield breaks past 5%, then this 5% starts to act as gravity, and it starts to pull down the multiple of the market. So this to my mind is a very interesting chart. It tells you that the US market in terms of PE, not as expensive as it could have been. It's been far more expensive in the past. But if the bond yield continues to push higher, then history suggests there is a risk of that PE multiple being pulled down. And if what I described in the previous slide were to become a actual risk, which is to say the capex does play out, the companies are not generating cash flow, but at the same time, the capex does not convert into profitability and productivity for the economy in general, then you could see a scenario in which the poor return on capital, the poor investment decision, which is what it would then be treated at, along with the decline in profitability on all that capex, would cause earnings itself to slow down, and that could be accompanied by a potential risk of the valuation multiples themselves starting to come down. Current bond yields in the US are about 4.4, 4.5% for the 10-year, but with no sign of the US deficits coming down. In fact, the president has talked about spending even more on defense. This is something that we should continue to watch, the interplay between the bond yields and the PE ratio. Finally, moving on to another dimension of this. Now, it's a little premature to call this a risk, but this is just once again a reflection of US household ownership of stocks and what percentage of their total assets is sitting in stocks. Now, you can see over there that this is also typically a cyclical number. It goes up, it goes down, it goes up again, then it comes down again. Now, in the last decade after the GFC 2008-9, it has been going through a straight line in terms of the rise. Now, again, history suggests that these kind of metrics also tend to go through cycles, and therefore by being at a record high by itself does not constitute a risk. Given the cyclical tendency of this, I would submit that when you have such high ownership of stocks, this creates a cycle of reflexivity, as we call it, which is that as the market sells off, it actually impacts the behavior of households, and that in turn becomes a reinforcing feature of a recession. And we have seen this pattern play out even earlier over here, when during a positive asset cycle, household ownership of our stocks went up, and then when you saw a negative cycle, actually the ownership of stocks dropped. So this, to my mind, once again, is a risk to watch out for, because this data point by definition tends to have cycles.
Those were very helpful insights, Vetri. Taking the conversation forward, how is Asia or emerging markets benefiting from AI capex? And what are the flow trends in emerging markets telling us?
Sure. So that's a very interesting question, Sonal. And I think, many people talk about this key. You don't know who is the company who will actually benefit from AI. Will it be the company which creates the LLM and the models that will help you? Will it be the companies who will actually use that AI to create productivity? This is always a very ephemeral question. But, there is an old story that when the people in the US, if you remember, there was what was known as the Great Gold Rush in the US, happened almost 200 years ago, when people went from the East Coast to the West Coast in search of gold. And at that point of time, people always joke that doesn't matter whether you find gold or not, but the person who sells the picks and the shovels and the crowbars that people need to do mining, they are the ones who will make the money. And this is literally what you are seeing happening in this slide over here, because initially the discussions used to all be about the Mag 7. These are the companies who are using NVIDIA chips, they are doing the LLM, they are doing a lot of that exciting work where the IPR happens. But to do that work, they need chips, right? They need the simple chips, the hardware that is required to support this computing operation. And this chart is very interesting because look at this: Samsung Electronics Korea, SK Hynix Korea, TSMC Taiwan. These companies' profits are now exceeding that of companies like Apple, Microsoft, NVIDIA, Amazon. So this is a remarkable chart. Just look at that growth which is happening in the profits of a company like Samsung because of the demand for DRAM chips. And they are, of course, the leading manufacturer worldwide. It is on course to perhaps be the world's most profitable company next year. And it is this dramatic takeoff in profits, which is actually now causing Asian tech hardware company profits to surge. These are the companies with picks and shovels. They are selling the wheelbarrows, the picks and shovels. They are not selling the high-tech product. These are the commodity products that the IPR businesses need, and they have become the most profitable companies in the world. Now, as a result of this, of course, Asia and Asia Tech has been among the best performing countries and markets in the world. You will be able to see that on the next slide. So if we go to the next slide at this point of time, um, this just shows you, here we have first of all plotted the performance of the EMs relative to the DMs starting from October 2025, and you can see how there is a dramatic improvement in the performance of the EMs vis-a-vis the DMs starting from early calendar 2025. Now, why is this happening? The big outperformance in the EMs is coming from markets like Korea and Taiwan. Of course, there are many other EMs outperforming as well, but particularly I would call out Korea and Taiwan because these are the companies where TSMC, SK Hynix, and TSMC are based, and they are the companies and the countries who have had the best performing stocks in recent times. Korea up more than 100 odd percent, same for Taiwan. Now, many people, very interestingly, talk about the fact that why should foreigners invest in India when they have such exciting hardware driven AI plays in other parts of the world, markets like Korea and markets like Taiwan. Now, this is very funny, but if you look at the data on the right hand side, the data on the right hand side tells you that despite having such companies, which I showed you on the previous slide, even Korea and Taiwan are currently experiencing outflows from their equity markets by foreigners. So this line that you see here is the performance of the Korean stock exchange. You can see it has gone ballistic in this period. This is the net outflow from foreigners in Korea. And in the last 1 year, it has actually gone even more negative, which means Korea is outperforming despite the fact that foreigners are pulling out money. It is not that because of the AI story, foreign money is going into Korea and that's why it is outperforming. Korea is doing well for the same reason that Indian markets have been doing relatively well, which is that domestic investors are pumping money into that market. Foreigners have actually withdrawn money from Korea. Foreigners have actually withdrawn money from Taiwan, despite the fact that Taiwan is actually a rocket like market driven by, of course, TSMC. So, this is a very interesting dichotomy. Are EMs outperforming DMs? Answer is yes. What is it driven by? It is driven by particularly tech hardware, but even those markets are currently not seeing inflows from foreigners. In fact, foreigners are pulling out money from that markets. So every time you feel jealous about Korea and Taiwan, oh my God, foreigners are buying those markets. They are not buying our market. They are not buying our market because we have no AI. Please remember, those markets have AI, and even then, foreigners are pulling out money. Ask somebody to explain that to you. Moving on from that, yeah, okay, back to you, Sonal.
Yeah, better bringing the conversation closer home. India has largely seen a sideways market since highs of September 2024. How do you compare India's performance with other global markets, and what do you think have been the key drivers of this relative performance?
Sure. So we can look at some of the slides relative to India's performance. On the left-hand side, what we are looking at is India's relative performance, not absolute performance, compared to the world index over a 12-month period. On a 12-month basis, this is one of the worst performances we have seen on a rolling 12-month basis for India. This was another previous low. This was another previous low around 13, 14. But this has come when a lot of the world is doing well, and we have significantly underperformed the rest of the world. One reason is, of course, markets which are AI, hardware, tech related have done far better. We saw the example of Korea and Taiwan. Forget who's buying and selling, but those markets have just done better. Their companies have done better, so we've underperformed. This is relative to the world, of course. So when they say world, it includes US, because US is 2/3 of the world. So this is a very AI driven index. But even if you compare India just on the right hand side, which is only to emerging markets, even there the underperformance is quite stark, 54%. And please remember, markets like, let's say, a Poland or a Brazil or a Mexico, which have done quite well over the last 12 months to 24 months, they also don't have any AI plays in them, but even they have done well. So without doubt, India's underperformance to EMs and DMs is not limited to any one single metric or one single causality. It is not only because foreigners are selling, it is not only because there is no AI. There are multiple reasons for why anything happens in the market. And this is, I think, one of those examples that we can see over here. That I think there are many reasons, but this is the outcome. We have underperformed. We can just go to the next slide. To my mind, it's always a good thing to understand risk. And to my mind, risk is nothing but the risk which is posed by valuations. When valuations are high, it means expectations are already high. When valuations are cheap, it means that expectations are quite low. The challenge that India has is that when you look at its valuations, you can see in this chart over here, India and US stand much higher than almost all other markets in the world, including composites. Like if you look at the EM over here, you look at ASEAN, you can see that even compared to these composites, India and US are very, very expensive, one standard deviation above the long term average. So this is one challenge for India. The second challenge for India is here on the right hand side. Look at India's EPS growth 26 to 27. You can see that we are not top of the table in terms of our EPS growth. There are so many markets: Korea, Taiwan, South Africa, China, LATAM. LATAM doesn't have any real AI plays, but all these markets have much higher earnings growth. So if you divide the PE ratio by the earnings growth, you get what we call the PEG ratio. When you look at the PEG ratio, look how cheap Korea and Taiwan are, even EM is cheap, and look where India is. Of course, there are some parts which are even more expensive, but this is one problem for India. You are expensive, you don't have earnings growth, and at the same time you don't have the AI story. So I think there are many reasons: starting valuations, lack of earnings growth, and the PEG ratio. But all of these are, so to speak, contributing factors to India's underperformance. Moving on. Yeah, back to you, Sonal.
Yeah, another area that has remained in focus this year has been the rupee, which has been among the weaker performing currencies in FY26. Is this something we should be concerned about from a macroeconomic standpoint? And how do you see currency weakness impacting India's trade dynamics?
Sure, I think India's currency weakness is really something to worry about. But having said that, do keep in mind that this is what we call India's real effective exchange rate. Once again, like many things in the market, it tends to be cyclical. The more time you spend in the market, more you will come to the conclusion that in markets, the one thing which cannot be avoided is cyclicality. Now, you can see this period where particularly the currency was very strong. Since then, you have had a continuous sell off. So now it has clearly bought the RER. So RER has a base of 100, that is reflecting the base year where it has been started. But just relative to the RER, we are now clearly in an undervalued zone. So yes, it is disappointing to see what recent performance of the rupee has been. But if I were to just look at its positioning today, this would suggest that the worst of the rupee fall is now behind us. It's not as badly positioned as 2013, but I would also submit that in 2013 our macro parameters were very vulnerable. Today our macro parameters are not as vulnerable. The other thing to keep in mind is, as you can see over here, sharp falls are followed by sharp bounce backs. Right? So always keep that in mind. There are cycles. What goes down goes up. What goes up comes down. Moving on to the next slide, I think this just provides a slightly different template. This goes back to many things that we have been discussing in the past, which is India's need to focus on manufacturing. Why do we need to focus on manufacturing? Because India has one of the weakest trade balances in the world. So when it comes to the manufacturing economy, we tend to be much, much weaker as compared to most other geographies. Our goods trade balance is almost 8.5% of GDP. Having said that, I would say every economy always has a combination of strengths and weaknesses. And on the right hand side, you can see India's strength, which is 46% of our exports come from services. So we do have a strength which compensates us for a weakness. But this weakness particularly becomes more painful in an environment where oil prices are high, because energy prices are always a significant component of manufacturing, and therefore India needs to resolve both its energy dependence as well as it needs to improve its manufacturing competitiveness if it wishes to address its weaker position when it comes to the goods trade balance. Yeah, this is just looking at market performance, and this is just looking at very short-term market performance. Remember, the conflict broke out 27th February 2026, 11th of May 2026. That was yesterday. What has been the performance of markets during this period from the time the war started? MSCI emerging markets plus 7.55%, S&P 500 plus 7.99%, MSCI World plus 5.12%. Not surprising. Remember, this is 60% of the US market, rather, is 60% of MSCI World. So that relationship is obviously kicking in over there. During the same period, India's performance quite disappointing. Nifty 100, which is our top 100 companies, minus 8%. Nifty mid cap minus 1.4%. Small cap index has held up quite well, I must say, against all expectations. It is actually plus 3%. Now, all these numbers are in US dollar terms. So, broadly speaking, this is your Nifty 100 worst performing. That's your mid cap index. Then you have the small cap index, and these two are the best performing indices, which is the S&P 500, and then of course the MSCI EM index. Those are the best performing parts of the world. Looking on at the next slide, this just presents data on a much longer term basis. Remember, we talked about the sideways market. You could argue that the sideways market actually started somewhere in May 2024 to now. The 1 year return for the Nifty is minus 1%. 2 years annualized return is 4.3%. The mid cap index is actually the best performing, 11% over 1 year, 8.5% over 2 years. The small cap index, very good performance over the last 1 year, but on 2 years, 3.4%, it's still underperforming the large cap index. But we'll talk more about our preferences later. Moving on from this, I think we'll move on to our regular section. I won't spend too much time on this. Earnings growth for March 2026 expected to be 5%. 27-28 still very healthy earnings prospects, 15% and 17% as per the earnings Bloomberg consensus. But I still think 2027 earnings are at risk. Analysts are still figuring out how much they need to cut them. Though, of course, you could argue that this is a one-time cut and not a sustainable cut. But net, there is a risk to FY27 earnings. Moving on to the next slide. This shows you the NSE 500, which is the top 500 companies in the country. How many of them are growing faster than 10% year on year? Very good data for the 245 companies who have reported results so far. Nearly about 60% of the companies reporting revenue growth higher than 10%, and nearly about 65% of the companies reporting PAT growth of higher than 10% year on year. So certainly 4Q FY 2026 proving to be a very good year for a quarter for earnings, though the previous 3 quarters were a lot more subdued. Risk to FY27 is something that we'll still have to grapple with. Moving on to the next slide. This is where we talk about equity market valuations. This is the Nifty 50 trailing PE multiple. This is the fair value zone in white, and you can see the market is above the average line in yellow, but at the same time in the white zone. On a forward PE multiple basis, again, it is in the white zone, which is the fairly valued zone, though it is above the long-term average. On the next slide, you'll see the price to book multiples, which I tend to prefer. And over here, actually, it gives you a different picture, which is to say that it is in the fair value zone, but it is also below the long-term average. And this is what caused many of our asset allocation funds to actually increase their equity allocation, but we'll talk more about that later. We can just go to the next slide on mid caps and small caps. You can see over here, mid caps still in that expensive zone. Small caps, after a long time, they came within the fair value zone in March, but the sharp bounce back in the last 2 months, I must say, against my expectations, has certainly caused the market to sort of, get back into the rich territory. So from our point of view, there's still a lot more comfort in large cap valuations as compared to mid and small, though on a bottom up basis, I think the fund managers tell me that they now see more opportunities, and maybe Srivatsa will also talk about that later. Quickly jumping through to our asset allocation model that I talked about, which is our proprietary equity valuation indicator. This combines P multiple, price to book, dividend yield, and the comparison to bond yields. When this indicator is in the green zone, which is where it is right now, it is in the increase equity allocation zone. So investors can consider increasing their equity allocation in a staggered manner. It has not entered the dark green zone, which is the significantly increase, but certainly it's running around in the increased equity allocation zone after a time where it was actually had entered the rich zone. If you see September 2024, it was rich. If you see September, October 2021, also valuations were very rich. Uh, what kind of returns are associated with those making an investment in this green zone? You can see that on the next slide. So this is the green zone I was talking about. If you look at historical data, 30% of the time the market trades in this range. During that time, the average 1 year forward return is 14%. The best 1 year return is 52%. The worst return is minus 21%. Only 7% of the time do you get a negative return. So that is why we consider this to be a good time to invest. And also 56% of the time when you invest in the Nifty 50, and reason I'm saying Nifty 50 is that this data is modeled on Nifty 50, 56% of the time your 1 year average return forward return tends to be better than 12%. So that is why this is a zone which we consider to be favorable for increasing equity allocation. So with that, we'll jump through to our final slide, which is the conclusion and some of our takeaways. The disruption in supply chains and elevated crude oil prices continue to pose a risk to India's macroeconomic stability. If you don't pass through the fuel price hike, then that burden will be have to borne by the fiscal deficit, by the government. That will cause the government to issue more bonds. That causes rates to go up. If you pass through the entire impact of fuel prices, it causes inflation to go up. It will create pressures on companies in terms of their profitability. And, once again, interest rates could perhaps move up in that scenario. So I think those are the challenges to India's macroeconomic stability, not to forget the fact that the current account deficit also becomes a pain point during this scenario, which is why we have seen the weak currency. So essentially, this disruption in supply chains and elevated crude oil prices are a potential risk to India's macroeconomic stability. We talked about the tech-driven hardware markets in Asia benefiting from global investments in AI. We talked about the US economy being very resilient. Markets have more than recovered, and in fact, expectations of rate cuts have been pushed back. We talked about the risk to earnings in FY27 because of the disruptions. So from our point of view, the equity allocation indicator is in the increased equity allocation zone. But because we remain in a very volatile geopolitical sensitive environment, we would continue to recommend that investors should prioritize asset allocation and risk management. We like the entire series of hybrid funds. They can be considered for lump sum allocations. And as a cycle, growth quality has significantly underperformed value. I know I've been saying this for more than a year or two now, but if you ask me where the point of cyclicality can come, this is where potentially there is some room for inversion. So I think I'll conclude over earlier, but I'll pause over there and hand it over to Srivatsa, who will now talk about how he manages the UTI Large and Mid Cap Fund. Over to you, Srivatsa.
Yeah, thank you, Vetri. Hi, good afternoon. I'm Srivatsa, and I manage the UTI Large and Mid Cap Fund, which is in the large and mid cap category. So it has both the large and the mid cap, which is more than 35%, as well as a decent allocation to the small cap part of the portfolio. Yeah, over to you, Sonal.
Yeah.
Questions.
Thanks, Srivatsa. To start with, could you help our audience understand the investment strategy of UTI Large and Mid Cap Fund and the key elements that shape your investment approach?
Yeah, if you look at the UTI Large and Mid Cap Fund, we have a very distinct value philosophy. And when I say value philosophy, it's not the traditional value. Of course, we have got some allocation towards the traditional value, which is there in the slide. But we look at value from four parameters. The first is relative valuation, where we look at well-established companies available at valuations lower than their long-term averages. The second is mispriced companies across the spectrum of large, mid, and small caps, where the market is probably not anticipating or not recognizing the sharp improvements or the sharp improvement in the ROCE and are available at very cheap valuations. Wherever possible, if valuations permits, we do look at growth, but the valuation is a very, very important criteria for us. So we don't buy growth at any price. The last is what we call pure value, is the original value definition of stocks available cheap, stocks available at say more than 4-5% dividend yield, available below book. Historically, they have not proved to be very good long-term value creators, but yes, as and when we see opportunities, we do take some tactical calls in them, but they are relatively a smaller part of the portfolio.
Sure. Since let's just unpack these elements a bit further. Could you help us understand how you apply these principles in practice? How do you go about identifying businesses that fit within these investment parameters?
Yeah, sure. So if you look at the first one, which I talked about, is established leaders at attractive valuation. Now, if you look at the last many years, you see a lot of blue chip companies like say an Infosys or a Sun Pharma or an ITC. You can name any company. They hardly trade at the same valuation over a longer time frame. Sometimes they trade much above mean. Sometimes they trade much below mean. Now, the reason is that they are also, bounded by what happens in the macro. Like, say, for example, today, what is happening in the IT side? There is a kind of a weakness in the IT because of the threat of AI. So the valuations have come down meaningfully. Sometimes it could be company specific, where some of these companies are facing challenges on account of some internal issues. So these could be all short-term issues. However, the markets does punish them in the short term if they don't see the earnings visibility, or they are, worried about something, what's happening on the macro side, which kind of impacts their business. Hence, there is a chance of us getting these companies at very favorable valuations vis-a-vis the longer term, valuation range. Just to give some examples, if I take through these four companies, I'm sure all of you would agree that they are the best in class companies which have generated humongous, wealth over the last 20-25 years. But if you look at the valuation ranges over the last 10 years, they've seen very, very wild swings depending upon the situation at that particular point of time. So for example, if I take Infosys, I go back all the way back to 2013 or even 2017, there were some worries on the IT spends. The company reported a couple of weak quarters and the markets did punish them. However, 3 years later, or 4 years later in December 2021, they also got one of their highest valuations in the last 15-20 years because the outlook improved considerably. They were making record profit margins. The same thing goes with Sun Pharma, ITC. So in short, I think you would find a lot of high quality companies trending at lower valuations because of certain short-term issues. And that's the time we come and step in. So I would say it's more something like an anti-momentum that, we are convinced that these companies have created a great long-term record. We know that it's just a blip and they will resume their journey once a certain time frame passes by, and we stand by them and we increase our allocations in these companies. The next one is probably the reverse of the first one, in the sense that the first one have created great long-term track record. The second one may not have a very great long-term track record, either of certain issues in the past. But what we look out for is whether there's a massive change in the improvement. We kind of look for various signs. There's an improved governance, better operating metrics, change in the regulatory environment, or focus on shareholders' value creation. Once we are convinced that there is a change, of course, most of these companies would be available at a very reasonable valuations because they have not been able to create a great long-term value. It's all under-owned. Investors have given them a pass. we are very careful in our stock selection here. So we don't probably, if we identify 10 such stocks, we would probably get into them only in two, three of them. But the idea is to get into them only when we are convinced that there is a improvement happening on those parameters. It's not a valuation call that the stocks are cheap. So I think this is one of the key elements of our strategy, which has kind of worked very well for us in the last 3 to 5 years. The next one. So here are some of these examples. These stocks have not probably created great long-term value a couple of years back, but we saw a change in the business model, a change in the management, or a kind of a change in the shareholders' allocation strategy, which kind of helped us generate a very decent alpha in these kind of stocks. Yeah, next one. I think the third one is, as far as possible, as valuation permits, get into growth-oriented stocks. But I would say in today's environment and probably in the last 3, 4 years, it's been very hard to find, at least in the large and mid-cap space, a growth-oriented stock available at a reasonable valuation. So wherever possible, we try and scan through the small cap space to find if we can, find any kind of stocks. But again, the main criteria is what we pay for it. We don't want to overpay for the growth. So we ensure that, whatever we pay for it is reasonable. Next one. Again, in terms of the small caps, our focus is to ensure that, because this is the riskier part of the portfolio, our focus is to ensure that we get into decent quality small caps, high quality small caps, and we do a lot of due diligence on them. And it's also spread out. So, for example, the weightages could be 13 to 14%, but it's spread out across 18 to 20 companies to ensure that the risk is kind of minimized as far as the small caps part is concerned. Next one. Again, some of the illustrations of our growth-oriented small cap companies. Some of them are not very well discovered. I think that's what we prefer getting into. But we do a lot of due diligence here, far, far higher, to ensure that it meets all our rigorous quality parameters that we have set for ourselves in the small cap space. Next one. Coming to the last one, this is what I called a pure value. As I said, it's available cheap, high dividend yield, a low P ratio, sub 10 P ratio, below book. But what clearly we look out for is not the valuation. We look out for other key triggers. Just to give an illustration, if I were to buy an upstream oil company, what I would look out for is not, there's always been available, let's say 4 to 5% dividend yield. But if there is a trigger, for example, of a production increase in the oil fields compared to say a 2-3% decline, that's something that I would look out for. And so all these companies which are value oriented, which would be the typical, as I said, available below book or any of those traditional value parameters, I need to see some other trigger apart from valuation for me to get into it. And also, this is not a very large part of the portfolio. We generally allocate maximum up to 10% in this category. And we are very cognizant of the risks of being in this category in the longer term. But yes, we get in when we only see triggers apart from low valuation. And we are also quite adept in kind of getting out if that kind of story has played out. The next one. You can skip this. Just to give a couple of illustrations on how we have been able to capture it. Look, if I look at the IT sector, in the beginning of COVID, when the valuations were down, we increased our allocation there. And then in 2021 end, when the valuations went up in a very big way, we actually went underweight. And if you look at the last 7, 8 months, this trade clearly hasn't played out in the last 4, 5 months, but we generally invest with a medium to longer term time frame. Again, as the valuations have trended down in the last 3, 4 months, we have steadily been increasing our allocation in the IT sector. So this clearly reinforces the valuation discipline we have on both ends, like back it when the valuation comes down, and when our belief is that there will be a kind of a mean reversion, and at the same time when the valuation goes excess, cut your positions, cut your overweight positions, and go underweight on it. Other one is, I think, capital goods, which is one of the most expensive sectors. If I look at the benchmark, we did have an overweight position 3, 4 years back, when the valuations were much, much more reasonable. But in the last 2, 3 years, we have barely had any positions. I think we are underweight to the extent of 75, 80%. Again, reinforcing our very strong value discipline that we do not want to get into sectors or stocks where the valuations are far higher than the mean. Yeah.
Thanks, Shubhatsa. Since the fund follows a relative value-oriented investment approach, self-discipline becomes equally important alongside stock selection. Could you walk us through the self-discipline framework for the fund?
Yeah, Sonal. So if you kind of look at the cell discipline, we have three buckets here. One is a valuation. I think, as I alluded in the previous slide, wherever valuation goes above mean or wherever the valuation cycle has played out, we do not hesitate in cutting our exposure, or in some cases, even completely exiting the kind of stock and looking at other ideas where value is. The second is risk control position sizing. So a lot of the stocks which I take, if they have given a 50% return in a flat market, obviously the weightages increases, but we kind of ensure that we kind of trim our weightages to ensure that our risks are kind of controlled. The third is again very important for a value oriented strategy is to see whether our original thesis has played out. In some of these cases, probably in 1 or 2 out of 10, I do observe that what I thought has clearly not played out. Either I was expecting some kind of a regulatory action or some kind of an unexpected regulatory risk which has come, or some kind of a promoter issue which has suddenly come, which from nowhere. In those cases, I clearly cut my losses and exit the stock and look out for better ideas. So these are the three broad framework I have for selling. Of course, valuation is the most critical. I also feel that it's also very critical to ensure that you keep on monitoring your stocks to see whether the original thesis is still relevant or not. If it is not relevant and if valuations still don't factor in the change circumstances, then don't hesitate to cut your losses and move search for better ideas.
Sure. Having discussed the broader investment framework, let's now turn to the portfolio construction. Specifically, how actively have you shifted sectoral weights within the fund?
Yeah, so I think the biggest changes, if you see, have probably have come in the IT side. As I said, as the valuations have corrected meaningfully, we have kind of increased our allocations in IT over the last quarter. Also, on the construction side, we found out that the outlook has improved considerably. The government focus on infrastructure is picking up. Valuations have corrected. The same thing with reality. I think that's also we see that there has been a decent correction in the overall reality stocks, and we have kind of made use of it. And services and media has remained constant. On the negative side, I would say financial services was something we were very overweight last year in April 25. But as we saw meaningful outperformance throughout the year, we cut our exposures and we have now gone underweight on financial services. The same thing with metals and minings. We were overweight and we ran through the cycle. And we have again cut our exposures in metals and mining in the last couple of months. Again, in aligning with our philosophy that the valuations have turned higher. Consumer durables, again, we have been underweight for a very vast period of time because of valuation related concerns, and we still continue to be underweight. Auto, we were underweight, we increased our positions, but the sharp outperformance in the last 3, 4 months, we have reduced some kind of weight. So clearly, in line with where value has, emerged in the last probably couple of quarters, we have kind of aligned with those sectors.
Sure, Srivatsa. From an investor's perspective, how should one look at investing in this fund in the context of long-term wealth creation?
Yeah, I mean, as we have been highlighting, the whole industry has seen a substantial flows through the SIP route, and that's enabled a lot of investors to have huge wealth creation over the longer term. And that's where our fund has done, reasonably well on the longer time frame. So if I have to take you through the 3 years, 5 years, 7 years, 8 years, and even 10 years, these are the SIP returns of the fund versus the benchmark. We've been able to create a decent amount of alpha over the longer term. If I at least go through the 3, 5, and 7 years, and also over the average peer category, but more specific to the benchmark, we've been able to demonstrate a decent amount of alpha over the longer term. So this fund is highly suitable for people who are seeking to create a long-term wealth through the SIP route. We've been able to demonstrate that consistently over the last 5 to 7 years. And that's again because of our strong discipline in identifying value-oriented sectors and moving from one sector to another. I think that's helped us, in kind of achieving this kind of performance in the last 5 to 7 years.
Sure. Thank you, Srivatsa, for taking us through the fund strategy and portfolio approach in such detail. With that, let me bring Vetri back into the conversation. We'll now move to the audience questions and take up some of the questions that we have received from the participants. Yeah, Vetri, my first question is for you. Crude oil prices have surged following the West Asia conflict, and our Prime Minister has called for fuel conservation and reduction in the non-essential travel. How serious is the energy import bill risk to the India's current account and fiscal math, and which sectors of the markets are most vulnerable?
Sure. Clearly, I mean, the fuel prices are a cause for concern. They have not yet been hiked. Government has, in fact, already absorbed some of the hike in fuel prices on its own books when they cut the excise duties on fuel. And of course, they also raised the export duty on fuel. So some companies are also bearing that cost. But net, the government cannot continue absorbing these higher fuel prices burden, and it will have to pass some of it down to the consumer. So I think that is the context in which we need to interpret the Prime Minister's call for greater, efficiency in the use of fuel. That is always a desirable goal, and in difficult times, I think it helps if everybody in the country comes together to support the national interest. But yeah, I think that's where it comes from. And remember that it's not just about fuel. The disruption in supply chains, as I say, is crude oil, but it is also fertilizer, because remember, urea is nothing but a byproduct of ammonia, and ammonia is essentially something that is very often made from natural gas and sometimes also from crude oil. So our entire supply chain for fertilizer is also at risk at this point of time. We have enough fertilizer for the current crop, the Kharif crop, but if this disturbance continues, there will be risks related to the availability of urea for the next cropping season. So I think there are multiple macroeconomic risks related to fuel, related to fertilizer. A product like sulfur is not easily available today. Prices have jumped up more than 100% in different geographies. This is a basic chemical which is used in so much production. So there are multiple disruptions going around all the place, and I think that is the context in which we need to see the recent comments by the Prime Minister.
Sure. Thanks, Petri. Those were really very insightful perspectives. Coming to you, Srivatsa, as a fund manager who has mastered the value style of investing, how do you distinguish between stocks that are genuinely cheap with a catalyst versus those that are cheap for a structural reason, leverage, disruption, or earnings deterioration?
Yeah, so I think we typically tend to look at the first part. I think stocks which are which have created long-term value, or where there is a kind of an improvement in the ROCE or improvement in the management quality, and they or improvement in the capital allocation. Versus the second part, I think second part is something that we have consistently avoided. So for example, any companies with very high leverage, or any companies with not a very great track record of corporate governance, or any other company which is highly influenced by regulations, which leads to a consistently lower outcomes on profitability, is something that we have always excluded in the portfolio. But sometimes we look at such companies only if there is a change. So, for example, if one were to say, look at a bank, a 7-8% ROE bank trading at 0.3 will not excite me. But if there is a direction of that 7-8% going to 13-14% and still trading at 0.6 price to book, is something that will excite me to see if that improvement can happen or not. So in terms of a strategy, I'm very clear. I want to focus on the first part where there is a kind of a track record the company has over the longer term, but trading cheap. Or the second one where the long term is not great, or the last, medium term is not great, but there is a turnaround which is very clearly visible and not appreciated by the market. The second part of the question that you asked, like, companies which are structurally having a problem is, which is something which is excluded from our universe. But we do look at it only when we see a convinced of a very sharp improvement in those companies, we tend to take them in the portfolio.
Sure. Vetri, my next question is for you. India has concluded landmark trade agreements with the US, EU, UK, and New Zealand in the last 6 months, arguably the most active trade diplomacy India has seen in the decades. Which of these deals do you think has the most meaningful near term alpha for equity investors, and which sectors should investors be watching?
Sure. I think it's very difficult right now to sort of forecast which sectors are the biggest beneficiaries of some of these trade deals. Also, remember these many of these trade deals have been structured in a way that it actually helps a lot of our labor intensive sectors, and some of those sectors may not actually have significant representation, particularly in the listed space. So I would say at this point, that is not something that I would translate into saying that it is only this or the other sector that would benefit. But I think particularly in the EU region, there is every reason to believe that some of our garmenters may be able to gain market share. But I think the benefits are really to be interpreted more at a country level rather than necessarily picking only one or the other sector as a winner. And as we've seen, eventually beneficiaries are those companies that are able to get the best out of the entire trade arrangement. So it comes down to execution rather than to potential.
Sure. Thank you, Vetri. Shrivatsa, has the recent market volatility created any fresh turnaround opportunities that were unavailable a few quarters ago?
I think yes, probably one has seen some kind of value emerging in some of these internet companies, which were probably, I won't say still they have value, but I think they have come to the levels where one can look at it. I mean, if you look at the growth expectations of some of these companies, clearly they can be met. Probably because of the fear of AI, they have corrected meaningfully. One can also look at some of these consumer durable companies now. We have been underweight for a long time, but there has been a meaningful correction. Again, from a pure value perspective, they are probably still a little expensive. But yes, vis-a-vis the longer term growth prospects, they could be kind of good candidates if there is a further correction in the prices of these stocks. So these are two sectors which have, corrected quite a lot in the last 1 year. And they could be opportunities which one can look at.
Sure. Srivastava, I have received a lot of questions from the audience on IT sector, given the sell-off in this sector, particularly with AI-led disruptions, and you are overweight in the sector. So, what is your view on the sector?
See, I started off my career as an IT analyst. So I think over the last 25 years, I have, seen huge changes happening in the sector once every 5, 6 years, whether it was movement towards ERP, whether it was towards digital, whether it was towards cloud. And the top five companies or even the entire sector has managed the transition very well. When was a big incumbency risk, they have been able to manage this transition extremely well. Of course, the current challenge is far bigger than what has been posed by the previous ones for sure. But I think their ability to manage these kind of challenges is kind of proven. The second part is, yes, the AI would probably tend to have some level of deflation or some level of margin pressure because the client is going to ask for the benefits. But I think today the market is pricing in a very, very low growth for the longer term. And definitely, my belief is that if an organization moves towards an AI, they do need the help of the IT service players to help them in doing it, because they are the ones who know what the existing network is, the existing data is. So to integrate those systems with the new AI systems, you would definitely need a help of a IT service players, which presents a very good longer term opportunity, which is probably the market is not pricing in that. They are definitely pricing in the near term weakness on account of deflation. But the long term opportunity which could create because of this, I think that is completely being ignored. And if I look at from a very traditional value metrics in terms of free cash flow yields, they are probably at one of the best levels one can see. So that still makes me overweight on the sector. Yes, it's not done well for the last couple of quarters, but I'm perfectly fine with it.
Your metric coming to you, no, FIs have been net sellers for quite some time, while DIIs are bringing support to the markets. So, is there any level of sustained FI selling that you see where DI simply will not be able to absorb?
Same. I've spent many years in the market, Sonal, and I eventually came to the conclusion that it's hard enough to figure out how companies are doing and how their businesses are going to be doing. But to my mind, that is the superior advantage that any of us has as investors. So I really don't spend my time trying to figure out which way foreign money will go and which way Indian money will go. For the first 25 years of my career, the money went only one way, which was there was only foreign money. All the domestic money was actually exiting the market, and Indian ownership of equities was coming down. In the last decade, we have seen a secular rise in the participation by Indian investors in our own market. And at the same time, in the last few years, foreigners have taken money out. Everybody has their own reason. Eventually, the returns that you earn from equities are a function of the earnings that those companies generate. Who is buying and who's selling is not a debate that I prefer to get into. And today, Sonal, we also shared the very interesting data which people may not be aware of, that the best performing markets, Korea and Taiwan, also have foreigners who have taken their money out. So go figure.
Yeah, right. In the interest of time, I'll just take two more questions. My first question is for you. A lot of investors are worried about elevated mid and small cap valuations. How are you approaching this segment currently within UTI large and mid cap fund?
Yeah, I think in terms of the fund philosophy, we are kind of very, very careful vis-a-vis the valuation. So because that's a primary criteria. So I think we need to invest a certain part of the portfolio in mid cap. So we are closer to that. I mean, it's 35% is the minimum. We are at say 36, 37. Even there, we try to see the stocks which are relatively more on the value part. Now, on the small cap part, I said, I think that's about 15% of the portfolio. That's the part where we are most careful about, not only in terms of the value that we are paying for, but more in terms of the quality that we are paying for. So we ensure that we get into companies which have low leverage, which have demonstrated high ROCs over the longer term and available at reasonable valuation, because they may probably not be very well discovered by the market. The second aspect is on the small cap part. As I said, it's 14-15% of the portfolio, but spread across 20 stocks. So the average weight is around 70-80 bips, which again helps us in kind of containing the risks should there be any kind of a liquidity issues or short-term volatility issues. On the mid cap part, yes, we need to have a certain part of the portfolio in mid caps. We are adhering to it, but again, we are ensuring that we are focusing more on the value side of the mid cap. So wherever, for example, if you look at the mid cap consumer durables or mid cap, some part of mid cap pharmaceuticals, or even mid cap IT, they are all trading at far higher valuations than the longer term mean. And we do not have, or capital goods. I think capital goods mid caps are the most expensive. So we are clearly underweight on all of them and focusing on mid caps within the sectors where there is a considerable amount of value.
Thank you, Srivatsa. Vetri, my last question is for you. For long-term investors, what would you say are the biggest mistakes to avoid in the current market environment?
Sure. I think, the point that I would make, which I was showing you in many of those charts where I was drawing the lines, is that many things in the markets are cyclical. There are times when the news flow is supportive. There are times when the news flow is not supportive. The way that the market adjusts for this is by taking valuations higher when people feel very confident about the future, when they are making very bold bets about how investments will yield returns in the future. And at the same time, valuations tend to be cheap when the news flow is adverse, when we are more concerned about what can happen in the short term, which can cause earnings to become weaker or cause macroeconomic parameters to be weaker. So these are all cycles. What is important is to not get carried away by greed when the news is good. What is important is to not get carried away by panic and fear when the valuations are cheap. Every time you look at a crisis, you have to ask yourself the question. It could be a crisis, it could be a setback. You have to ask yourself not the question, what are the challenges that this crisis creates for me, but equally, is this crisis actually an opportunity from which I can benefit? And while I would still not call this a crisis for India, the fact that equities have gone nowhere for 2 years, the valuations have corrected, we saw it in our proprietary valuation index, it means that the markets, in spite of all the negative news flow, are actually telling you from a valuation perspective, this is where the bad news is discounted in the price, the expectations are low, and therefore this is a good time to step forward into the markets with lump sum investments, maybe in hybrid funds, because that will allow you to handle the enhanced volatility in the short term better. But this is a time to step forward, but not a time to panic and exit the market. The news flow is always adverse when valuations are more reasonable. Today, we are certainly in that reasonable territory. And particularly, all of this I'm saying in the context of large caps. We saw in the valuations, there is a dichotomy between where the large cap valuations and where the small and mid cap valuations are.
Thank you, Vetri and Srivatsa, for those valuable insights and perspectives. To sum up, while the near-term environment continues to be influenced by the global uncertainties and evolving macro trends, markets are also reflecting underlying resilience and long-term opportunities. As always, staying disciplined and staying focused on the fundamentals remain the key. With that, we come to the end of today's session. We hope you found this session insightful and useful in navigating current market landscape. Thank you all for joining us today and for your continued trust in UTI Mutual Fund. Have a great evening ahead.
Thank you, everybody.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.